Hey, Marissa.
Hey, how you doing today?
I'm good. Good to see you.
Nice to see you as well.
I even forgot to put. I was so excited, I forgot to put myself on stage. I put
There
you
you
guys on
go.
stage. I'm
What's
excited.
up,
This
Dante?
is Hey, what is going on? This is a great treat, ladies and gentlemen. We have Andre Cottrell and Marissa Hazelwood with us. Appreciate both of you coming on.
No
We're gonna.
problem.
It's the Epic Lunch and Learn. We're going to be here for an hour answering your questions. You can put it right in the comments and the chats. We had a great response yesterday. We want to keep that going. We're going to be here this week, obviously today, and then we'll be back on Thursday to finish out the week. So definitely, let's just do the roundtable. Everyone, introduce yourselves to the audience so you can get familiar, and we'll take it from there.
All right.
Ladies first. We'll go with ladies first.
Cool beans. So I'll go first. I'm Marissa Hazelwood, loan officer with Epic Mortgage. Been a loan officer for the last 2 years, and enjoy being in the industry. Have past history as a closer and processor, so very experienced and well versed in the industry.
Awesome sauce. Andre, who are you?
Hey, I'm Andre Cottrell, NMLS 2130969. Coming up on 5 years for me
Whoa.
in the game. Been with Dante for about four now. Me and him have done pretty much everything under the sun as far as brokering. So still here, still learning, and yeah, having a good time.
Definitely, definitely. And this is coming live on YouTube, LinkedIn, and Facebook. So definitely would love to see comments, from all different platforms. If you have questions, you have a scenario that you want to ask us, that's what we're here for. Try to give you the whole mindset is to stay hungry for knowledge. And hopefully we can give you an hour of our time to answer questions that you may be going through, whether it's with another loan officer, whatever the case is. Um, I know Epic has a closing today for the Jones family, so that's going to be exciting. That's at 3 o'clock today. So we got a first-time home buyer buying a condo downtown Chicago, so that's lovely. And let's get into it. Let's talk about some things, and when people put comments in, we'll answer them. But what I wanted to share was yesterday we were talking about different loan types, different products, and not saying one is better than the other, but we can have that battle, that debate. We were talking about FHA, VA, USDA. We were also talking about conventional loans and different things like that. So one of the questions I wrote down for today was, which loan product is the easiest to qualify for right now, and which is the most misunderstood? Did anyone want to tackle that question?
I'll go. I
Okay.
say the easiest to qualify, in my opinion, would be conventional. It was just, your credit is semi decent. You can get there, and at the end of the day, I think it's a stronger approval, in my opinion. And I say the most misunderstood, it would probably be DPA because I just don't think a lot of people know what exactly that second is doing. Depending on how the loan is structured, and loan assistance is it can also, it can cripple some people, depending on the situation also. What about
Well,
you,
that
Marissa? What you think?
Cool beans. I'm gonna have to go the opposite of you. I think the easiest and to get right now is maybe FHA. A lot of people are struggling credit wise. Income just is not good for the market right now. So I'm gonna say FHA probably the easiest to go for right now, especially if you're struggling with credit issues and things of that sort.
I love that we have differences of opinions.
I've been
I
getting
knew
some
you
good
were
credit scores lately.
gonna say that.
Yeah, I mean, you both are right. There is no right or wrong. I mean, it really just depends on what neck of the woods you're dealing with. So if you are working with customers that have higher credit scores, it is easier because you're going to have less conditions. And more times than not, they're buttoned up as far as the documents, they have them available. They're financially responsible, and we do see a quicker and easier transition. But to your point, if people have had some derogatory history and credit history and challenges, FHA seems to be the easier route. So if it's hard to get, for example, I got a lady right now, 673 credit score, and she fell in love with a townhome, right? But in the Chicagoland area, we have a lot of listing agents that say, hey, check out this townhome, but it's actually a condo.
Mm-hmm.
And we get into that situation where, hey, most condos are not all FHA approved.
Yeah.
And so now what do we do? Now we're stuck, trying to see, can we get a 673 approved conventionally? And that's hard to do. So that's when it is a challenge. And because, it won't be 3% or 3.5% like an FHA would, you're talking about a potential situation where you might have to go ahead and, put down anywhere from, 10 to 15 to maybe even 20% down. So those are definitely challenges depending on, the credit score. So credit is definitely one that will dictate which route you can go. Have you guys had any experience or played around with like VA? What about VA for you guys?
Yeah, I've done very limited VA loans. I've talked about a few VAs, and I think I've done 2 veteran loans my whole career, so I haven't done that many. But I like the program, for our vets, help them get in the house. I mean, into a home. I think it's great, in my opinion.
Yeah, no doubt. What about you, Marissa?
I haven't really touched VA. I had a chance to do a couple of pre-approvals. I think it's the most misunderstood loan type out there because they think the process is just a little bit longer, a little tedious. It is a little extra steps, but I mean, it's great benefits towards it. No down payment, no PMI. So definitely most misunderstood, but the one with the most benefits.
Definitely misunderstood is this whole no down payment. Sometimes I know when I hear and it says no down payment, I quickly think, or I think a consumer thinks that means it's zero, right? I don't need to bring any money to
Nothing.
closing.
No.
Yeah.
But you guys know a different story. So why don't we unpack that a little bit?
Well, you're still gonna need your closing costs, just because they're taking care of your 3.5% of whatever your home purchase is. You still need the closing costs, and closing costs are still gonna be, another small percentage of the loan. Let's say 3 to 5%, somewhere in there between, depending on where you're living at, where you're getting your house at. So, then that closing cost will be expensive, especially if you're like, oh, we're about to buy a $500,000 house under the VA. We can afford it. We got the income for it, and they're gonna take care of that 3.5%. Now you still got closing costs, and you're like, oh, I still need to, go into my savings or dip out or into something else because you gotta bring some money to the table.
What about you, Marissa? What do you think about that?
Absolutely what Dre said. It's two pieces to the puzzle. I think a lot of consumers don't understand that. It's just they think it's just the one payment, the down payment, and you don't have to come with the closing costs. But exactly what Dre says, two pieces to the puzzle. Even though they're taking care of your down payment, you still have to come to the table with closing costs.
Definitely. And so when we do a pre-approval, especially at Epic, we try to make sure we're looking at bank statements because we want to make sure, do we have that type of funds? We have to have those conversations. It's not just the down payment. So we have programs, right? Dre, you talked about DPA. We have VA, obviously, options, also USDA. We see a lot of USDA, obviously, in our Texas, Georgia, and Florida, states more commonly. In the Illinois, that would be more Southern Illinois, or, probably the closest to the Chicagoland area, might be some outskirts of Joliet or Yorkville. But, those are options that do provide no down payment, but you still have to be mindful of this, of the closing costs, like you're saying. Let's, without further ado, let's make sure we answer Gerard. And I appreciate you, Gerard, for putting this in the chat. How does tax strategy actually impact mortgage approval chances? Now that's I would say that's kind of a vague question, but I'll try to answer that. Just tax strategy, I guess, and luckily we do have Marissa here who does taxes.
I knew you was gonna say that.
Mhm.
But very fortunate to have you on here. But I would say, to answer the question of tax strategy, obviously if you're dealing with a business owner, right? And we're dealing with a business owner, and we can look at maybe him filing what he did last year in his taxes, how much he claimed. And, potentially we can, kind of strategize on, hey, what does he need to claim for this year in order to qualify, or, to give him some glimpse of, ideas to how to move numbers to make them work per se. That would be, at least that's my interpretation of tax strategy. So I think tax strategy is very important because you have to let the accountant know what you're trying to do. because I think the mentality for most tax accountants is they're trying to steer clear for you of tax liabilities, meaning they're going to try to write off as much as they can. And if they do that, then you may not qualify for a mortgage. So, that's the counter to that. Marissa, you want to chime in on that?
Just exactly what you said. Being a business owner, you want to be careful of that bottom line, especially when you're going for a mortgage pre-approval within the next 2 years, right? We go off 2 years of history. So you want to make sure your taxes look good for those 2 years. Even if some cases you may not be able to write off everything because you have a bigger goal at hand. So just keep that in mind when you're going to your accountant. Let your accountant know your goals so they can be sure that they're preparing your taxes properly.
And one of the things I love about, just being a mortgage broker, we're a regional mortgage broker licensed in multiple states. One of the things it does, it allows us to work with a lot of different banks and lenders to get, solutions for you. We do have a whole product line. We're going to talk about it more on Thursday, I believe. But, definitely what we have are non-QM products. And non-QMs kind of sounds a little weird and exotic, but I like to just call them alternative income products. So if your tax returns aren't necessarily, up to standard, up to par, we can look at bank statement programs. We can look at 1099 programs. We can get CPA letter programs to help you qualify. Now, you will need a bigger down payment. We can't, utilize down payment assistance with the alternative income programs, but it could definitely help you, and you don't have to feel like, oh, I can't buy a house because, I've been writing off so much on my taxes and now I can't afford, obviously with more down payment, anything from 10, maybe even 20% down, we can use that route to help you qualify. And so I think that's a great option that we make sure we have to spread that word, obviously, to our consumers. What do you think about that?
That's exactly what it is.
Yeah. All right, we got another question already coming in, so appreciate you, Antoine. How do I know if I'm using my purchasing power smartly? Well, I'll give you a credit that purchasing power. I love that. Dre, you want to answer that one?
I look at that one a little differently because I think purchasing power doesn't really coincide with how much you want to pay for a mortgage. Just because you do have so much purchasing power doesn't mean that you want to use all of that purchasing power. And what I kind of mean is if you can, say, afford a $500,000 house because that's the purchasing power you got, that's where your ratios are at with your DTI and everything, you may not want a $400,000 mortgage. So that's why I just think about that one a little bit differently. But I would say to purchasing power smartly is, are you looking for a home that is going to have everything that you want in it at the price that you're approved for? Or do you need more or less and then try to find in there? I don't know. I do my mortgages based off how much people want to spend per month. So I don't do it based off how much you can afford. I don't know, Marissa, maybe you got a better take on that one.
No, you're right. It's basically what's your budget.
Yeah.
It all boils down to your budget and not your purchasing power. It's how much can you afford? How much can you spend? What's your savings goal? All that. What's your budget, basically?
Yeah, no doubt. I mean, you guys make me feel so well. You guys are saying it right off the bat. No, that's what it's about. It's about your payment. It's like, you don't, there's a lot of loan officers out there, that will just go ahead and max you out. So if you make $100,000, I'm going to qualify you for $500,000, because that's what you qualify for. Roughly on average, most people are going to qualify for about 4 to 5 times how much they make. And we're looking at gross income. So if you make $100,000, more than likely you're probably going to qualify for $400,000 to $500,000, and so that's what you'll get a pre-approved for. But they didn't go over the fact of, well, where are you trying to buy, and how much, based on your budget, how much do you got coming in, every 2 weeks? Most people are getting paid biweekly, and can you afford that? If your biweekly is coming in at $4,000, every 2 weeks, but your mortgage payment is $5,000, are you going to be okay with that? Those are things that you have to, kind of anticipate and understand, because that's important. So that's an important situation that come up. So yeah, payments are very important, and I don't want people to discard that ever. we want you to be conscious of your mortgage payment. What do you feel comfortable in making that mortgage payment? Because at the end of the day, after we close, that's on you to make that mortgage payment, not on me. You got to make that mortgage payment. So you got to be comfortable in what you're paying. So, appreciate that. We got some more questions coming in. So I appreciate that. This is Brad. Brad said, is smart tax alignment something most people overlook? Marissa, I'll let you tackle that.
Of course. I mean, I don't I don't even think people tax plan these days. I'm more of a accountant that worry about tax planning. So no, alignment it is been overlooked. It's more of what can give me the best? How do I pay the least in tax liability? That's what most people are worried about these days, paying the least. So I think it's not being aligned with tax planning. It's just strictly prepare my taxes, make sure I don't pay the most. And yeah, I think we can all use some tax planning in our life, I would say.
No doubt, no doubt. I mean, there's a new guy, Carlton Dennis. I don't know. Have you guys seen him on like IG or
Mm-mm.
Facebook? He's definitely on my feed. He's talking about tax strategies, and how just really he seems confident, knowledgeable, and maybe he read the tax code. Maybe he read from page 1 all the way to whatever amount of pages it is. But I just feel like there's so much we don't know, and there's so much a lack of education that really the schools provide us. It's about living life and really understanding these things. So I mean, it's a lot of word of mouth, and that's why we have to kind of create that own financial team around us that can be just a framework of resources, so we have a better understanding of just how do we live, how do we function, how does it work. What do you think about that, Dre?
I agree. Yeah, it's important. You gotta do some pre-thinking, and the success that I've had with my clients are people who are on those type of plans. They're on a 5-year plan. They're on a 10-year plan. They've planned. They've plotted. So I agree.
Yeah, no, I think it's very important that people are mindful of the taxes, and mindful of strategies. I mean, we got to plan it out. I'm the old head on this Zoom right here. Back in the day, being a loan officer, we were very reactive. People got into trouble, got late, something happened, and then we could quote unquote bail them out. And so it was like, oh, okay, you got yourself in trouble. All right, let me clean you up and send you back out into the real world. But nowadays, if someone came to, you, Marissa, you, Dre, and said, hey, I'm late on my mortgage 2 months, can you help me? I mean, pretty much the answer is no. You can't help them. So that proactive nature that, basically based on rules and guidelines have kind of created, we have to be proactive in our thinking, our strategies, what is the game plan? And that, always binges on your taxes, because that's what you're telling Uncle Sam how much money you made, and that could affect us.
Yep.
All right, we got another one here. Keep them coming too, folks. Any questions that you have, please put them in the comments. We're getting some love, obviously, from YouTube. I'd love to see some Facebook and LinkedIn, but keep them coming. Clive asks, can tax write-offs hurt your loan approval chances? And the answer is yes. I mean, that's what we're talking about, Clive. So basically, if you're a business owner and, you made $100,000, but you said I had $90,000 in expenses, from a mortgage aspect, we can only qualify you with $10,000. And we're looking at a 2-year history of that. So 10,000 is not going to get you done in this market. Values are still going up on the rise. And so that's kind of a situation that we have to deal with. So we have to be mindful of that. Is you really have to kind of strategize, hey, what am I trying to do in the next couple of years? Because I need to know effective way of how to handle my tax liabilities. How much am I going to claim? How much I'm trying to write off, so it doesn't impact my actual housing. So that's very important. Let's go to the next one. Don writes, thanks, Don. What's the best way to prep financially before applying for a mortgage? That's a great question. Who wants to take that one?
I'll take it.
Go ahead, Troy.
So the best way to prep financially, one is you have to have done at least some minimum research, learning that, if you're just buying a standard home, you're going to need 3.5% down plus closing. So, if you know how to do some percentages away, I'm sure I'm going off of you've done just a little bit of research. So the best way to prep is honestly is to tighten your belt as much as you can and save some money up. Save some money up, work on the credit that we've been talking about, that we talked about before. Make sure your taxes are in a good position, especially if you are a business owner and you're not W-2. If you're W-2, you really can't do much with your taxes. Your taxes are going to be what they are. So it's nothing you can really do from there. But really, it's just making sure you're good on the credit end, and also, you have some funds for your closing costs and your down payment. And what can also help though on the credit end is if you do have some things that you can pay off to open up your availability and how much more you can afford by paying down some cards, paying off a little loan that you had, paying off whatever that is going to be accounting negatively to how much you're going to be able to afford once you do apply. That's what I suggest you do.
Go ahead, Marissa.
I don't really have more to add. It just boiled down to credit and assets and your income. So make sure your credit is in a good place. At least know the minimum requirement, FHA 580. They go down to 500, but you want to come in 580, 620 to even be better. Just know the minimum requirements, credit, have the stable income, and then make sure you have some savings in place, and you should be good to go.
Oh, that's awesome. The only thing I would add is, I'm big on acronyms, Don. So if you are big on acronyms, it's CIA, credit, income, and assets. That is the key for applying for a mortgage. So is your credit aligned? You can check your credit. Obviously, there's multiple platforms to check it. You're not necessarily checking for a credit score, right? Because we do know the Credit Karmas of the world, they kind of, they give you a score, but that might not be the score we get, right? There's about 8 different credit scoring models out there. So, that's a situation that kind of occurs where with different scoring models, you can get misled, but you just want to make sure that, that you're paying everything on time and everything's in order. There's no surprise collection that you weren't aware of or anything that could, affect your credit. And then obviously your income, to Dre's point, if you're W-2, one thing that, separates us from others is we do have a W-2 only program, and that can really benefit some people, less documentation that we're asking for up front, and, can help you, especially even in times of needs where you may not necessarily have per se your taxes ready. We could just go off the W-2. So that could be a huge benefit. And then assets, obviously we're looking at, bank statements. Someone asked me, can I get a loan from my 401k? Yes, we can accept 401k. I got that question last night and I was like, yeah, if you have a 401k, we can use that money. So that could be huge as well. So don't, so we want to strategize and let's bring it to the table, see what's the best route so we can make this happen. We have a lot of situations in life. Life just happens. Life is life. I think, Miss Patrick told me that life be lifing sometimes.
Life do be lifing sometimes.
So that's a shout out to Miss Patrick. So I mean, with that being said, what does that mean? Well, that means like, someone dies and you're left a lump sum of money, and and then you need but you didn't want it in your account, so you switch it and put it into your daughter's account or something like that. Now that's a lump sum that you have to verify where that money came from. Like stuff, sometimes it makes sense to you and your family, but from the eyes of lenders, we're looking at you a little, cockeyed, like, what are you doing? So I mean, those are situations that do kind of come up that we have to kind of answer. And so strategizing, getting with a professional like ourselves, you want to do that up front. And, and before we get going, let's make sure we give contact information. I think that's important. So start off with Marissa and let's just go around. How do they get a hold of you?
You can reach me. Cell phone number is 773-290-9929. Or you can reach me by email, Marissa Hazel at epic.mortgage.
And Dre?
Yeah. Phone number is 708-378-6242. And my email is my last name, Cottrell. So Cottrell at epic.mortgage.
That's awesome. And obviously you can reach me at the office. This is the corporate office here, 708-905-5300, 708-905-5300, or my email, Dante, Dante, at epic.mortgage. So, reach out to one of us if you have any questions, especially after this. But, Yeah, we're here to help you. And like I said, keep them coming. This makes it easier for us to know exactly what you want to hear, what you need to hear, and we're here for you. So I appreciate everyone chiming in. So Allie, I'm going to say, hopefully I said the name right. What are the hidden benefits of working with a mortgage strategist? Well, you want me to take that, or what do you guys? Who wants to
Yeah,
take that?
Dante, you
I
got that
want to
one.
hear you. What you gotta say?
I mean, obviously, I'm going to be biased. I mean, I believe a mortgage broker has multiple products and programs. When I'm talking to realtors, when I'm talking to, even customers, I am a Swiss Army knife, because I can help you, as far as knowledge base, help you, give you ideas about credit. We have ability to work with different programs, as far as products that we have inside. We can work on your credit. So I can give you estimates on what you need to do to improve your credit score to increase. I can also, give you just knowledge and base on what I've seen others do as a mortgage broker, to the point, we have alternative income products. We also have regular products. So, your traditional products of USDA, VA, conventional FHA, we have all those things. We're VA certified, but we also have those alternative income products where we can go with bank statements. Sometimes we still have loans that are no income verified assets. So we have a lot that we can bring to the table. And so we can help you in all types of ways, shapes and forms, whether you're buying your primary home or if you're buying, an investment property. One of the things that we always talk about is, kind of the three things that we focus on is helping people, restructure their debt through a refinance or buying investment properties, whether you're trying to fix and flip, Airbnb, or a long-term buy and hold. So we can do renovations on both sides of the fence. Sometimes when you go to the local bank, the local lender, the big box bank, they only have one set of guidelines. They only do one thing. Where we have, we're licensed and approved with over 50 different lenders across the country. So it's just a ample amount of products and programs that we have for you and unique situations. So definitely those are the hidden benefits. Not every loan officer, is the same. And so, that's the thing that really separates, working with mortgage brokers. An independent mortgage broker, we're not tied to one lender. We can go to multiple places. And I think that gets the job done. What do you guys think about that?
Oh yeah, 100%.
Hitting on the head.
Yeah.
All right. Well, we got questions, so let's keep them coming. Chris, is there a difference in strategy for W-2 versus 1099 buyers? Great question, Chris. What you guys say?
I'll take it. It's a tax question, right? So it goes back to what we were talking about earlier, far as W-2, right? The income is just what it is. It's stated already on the W-2 versus your 1099 buyer, your income is flowing to what we call in the tax world a Schedule C, right? A business tax form where you have the opportunity to write off expenses. So the strategic move was to write off less expenses, show more income so you can have more purchasing power. But yeah, just be sure that you keep in mind how much being written off as a 1099 buyer.
Awesome. Dre, you want to add to that?
As far as the strategy on us, it's just how we're calculating your income. That's what I would say to that. It's just a little bit different steps that you're gonna take with somebody who's W-2 than 1099. But everything Marissa just said is it's what we're actually doing. So yeah, that's really all I have on that.
Yeah, I mean, if we go a little bit deeper, just a little bit, for you, Chris, W-2, just like Marissa said. But let's focus on the 1099. So if you got 1099 income, that means there's no taxes being taken out, right? Am I correct on that?
Correct.
So basically that means you're viewed as an independent contractor. And when you're an independent contractor, that means you're going to file what is called a Schedule C on your tax returns. Okay. And so the major, I would say probably the major two schedules that we see on tax returns, if we have to go that route, is Schedule C and Schedule E. Okay. And so Schedule E is normally for real estate owned. So if you have properties that you own in real estate, or if you have like a corporation or, some type of corporation, you'll see Schedule E income. On Schedule C, that's all independent. So 1099, you would probably be a Schedule C. Your independent LLCs will see on a Schedule C, okay? And so we have to look at a 2-year history if we're trying to do a traditional full document deal with the 1099 income. Now, you have the ability as an independent to write off, for clothes, for mileage, for, a whole host of things you can write off as 1099 income. So we can actually do, if the 2-year history works, we can go that route. Or we can actually use your 1099s and go with alternative income. And that's the difference between working with us and others. We have ability to work with the 1099 income as is. And so it's going to be a bigger down payment based on your credit score. But we can still get you that house. We can still get you investing in properties. We can still make it happen. So there is a difference in strategy. It depends. We would have to obviously see, and everyone's individual situation is different, right, guys?
Mhm.
So we're talking right now in generalities. There's nothing specific. We would have to look at you individually and see how we could help you. But definitely there are different strategies, with W-2 versus 1099 for sure. And we could go deeper with W-2 income. It kind of depends on hourly versus salary, right?
Mm-hmm. Also, yeah.
I mean, you want to talk about how much of a difference that can be sometimes.
Yep.
Dre, you've been there with that, right? Hourly, someone hourly income and it fluctuates. And what do
Yep.
we have to do on those situations?
Adjust the income, do more calculations. It's gonna keep changing, unfortunately, and that's why we try to use averages at the end of the day. That's basically the way we kind of combat that. But sometimes to get a file through, we may have to take a year-to-date pay stub and do a little bit more math to get you qualified or get you more money. Whatever we're doing, like Dante said, on the individual basis, it's just so different.
Yeah, no, it definitely is. All right, we got more questions, so let's keep them coming.
Mhm.
Clive writes, should buyers prioritize paying off debt or saving for a down payment? Oh, that's a great question.
I'll take that one. And
Yep.
like we said, this one is individually based. But my opinion is, and what everybody used to tell me is that if you have debt, you don't really have savings. Now,
Mm.
I coined that a little differently because it's the difference between planned debt. There's a difference between, you got some money in your bank account, but you purposely wanted to pay off that trip in 4 payments to go to Cancun, and you didn't want to pay it all off, and that's the debt that you're holding. But if you just got credit card debt, if you got a card that you owe $1,000 on, you got $1,000 on the bank, to me, I think that you are at a wash, because you should be paying that back. And I'm not saying paying it all back because we want to keep credit, 30% utilized and everything. So that's why I mean it's on an individual basis. But of course, at the end of the day, saving for a down payment is what's going to get you into a house. And we do have strategies on how to minimize how much debt you have to actually pay back to get into that house. So, it's a bit of a push and a pull with that for me, in my opinion. But saving for the down payment is going to get you in the house. Hopefully, getting you in that house is going to save you money off of renting, which is going to help you then pay off the debt.
Very good. What do you say, Marissa?
I have nothing to add. Dre hit it on the head.
Yeah, I mean, I'm just trying to think. Who's David? Who's the little guru, the little financial guru?
Who?
Um,
Ramsey?
Man, yeah, I was like, man, we got the Black Dave Ramsey right here,
Man, come on.
breaking it down. I was like,
I mean,
okay,
he
okay,
been the
Dre,
line. If you got that, and you got some debt.
man,
I like that line right there, Dre.
I'm just saying, you
man,
don't really got no money if you got debt. You got 10,000 in the bank right now, but if you owe creditors 10,000, you ain't got no money.
Like you
That's just
said.
making you feel better. You keeping that 10,000 in your savings is just making you feel better every day, waking up that you got some money, but you really don't.
Right. Net worth
yeah,
still brought down to 0.
Mm-hmm.
yeah. The only thing I would add to the question is, everything has sequence, right? Everything has a timeline. So once again, the first step is you're going to fill out an application with us, right? We're going to pull your credit. So, are you a 643 credit score? And you're asking me, hey, should I continue to pay off debt to improve my credit? Or should I continue to save money for a down payment? Well, 640 gets the job done. So we can pause on paying off any more debt and we can focus on saving money. So when those checks are coming in, I would focus on, hey, let's keep putting money into the bank so you have enough for a down payment. But now if you're a 570 or a 550, it's a different story.
Yep.
That's where, hey, we need you to pay off the debt first so we can improve the credit score. Then, and now, oh, well, I only had 10,000 and I had to use, to Dre's point, I had to use 10,000 to try to get my score up. So now I qualify. Okay. Well, now we're going to have to pause again to rebuild that 10,000 back up again. So the sequence is going to kind of make me realize what do we need to do. But I do get a couple people, some people trying to get that A in math, and they're like, I'm a 660, but I'm going to keep paying off this debt so I can get my score up. And I'm like, pause on all that. You got a score that can qualify. Let's not use all your money up, and now you don't have money for a down payment. Let's focus on moving forward with just continue to save money, and let's close this thing out. So great question. I like that.
Yeah.
All right, we got another one. Damien, are there lending strategies specific to high income earners? Ooh, that's a good question.
Why don't you take that one, Dante?
Are there lending strategies specific to high income earners? I would say yes, of course. The difference, but this is kind of a specific to you as an individual, because we don't know how you're getting paid. It's one thing if you were, making $500,000 and you're a CEO of some company. Well, that's simplistic, and we can figure it out. But it also depends on what are you trying to do. So there's a lot of you can't answer a question with a question, but in our line of work, there is a lot of answering questions with questions. So I need more information specifically to your situation, and then I could probably address that. I mean, obviously, if you're self-employed, making $500,000, how much are you claiming? How much income is really showing there? All those things would have to be evaluated and kind of figured out. And I think that's very important. So it's I'm not trying to get away from the question, but it's just too vague to really have a concrete thing. But just depends on what you're trying to do. I was working with a lady one time, and she was making $200,000 a year. And I was like, man, but she was terrified of debt, didn't like it, allergic to it. And she didn't want to have a purchase price over $200,000. You know what I mean? And I mean, it was so rare. I mean, she had a great job, vice president of, XYZ company. And I'm just thinking like, oh, okay, you want this $500,000 or you want 600,000? She's like, nope, I want $200,000 or less. That's all I'm looking for. I don't like debt. I don't like mortgage payments. I want to keep it as minimal as possible. So you really just don't know without knowing their story and what they feel comfortable with.
Yeah.
You know what I mean?
I can add to that also, Damien, like Dante said, don't have to know a little bit more about you, because you can be a high income earning. You could be earning $500,000 a year, but you could be living a $600,000 a year lifestyle, or a $500,000 a year lifestyle, and you don't have any money to actually benefit you in a home purchase because all your money is tied up in your lifestyle. Now, if you're actually good with your savings and you're a high income earning and you're actually netting savings per month, a benefit that you have as a high income earner with some savings is, you can put more on your down payment, which is going to lower your mortgage costs. You can, if there's room in your loan within the fee range, you can pay down, rate to get the rate that you want. Most people that we work with are not in a position to say, you know what, that mortgage is too expensive. I don't want to do 3%. Let's put 20% down. And you know what? That rate is too much. That rate is too high right there. I want to pay it down to this. So if you do have the income and the assets to do so, it definitely can benefit you, and being able to kind of structure your loan the way you want to pay to structure it.
Yeah. Yeah. I mean, obviously, if you're making additional money and you have a good savings, you could look to do some buy down situations to get that lowest payment possible. So yeah, no, that's definitely on the table.
Yeah.
Let's go to the next one. Danny wrote, this was eye-opening. Thank you, Marissa and Andre. Awesome.
You're welcome.
Awesome. And this is a great time. Again, let's just, because this is live. So let's pass out that information. And once again, how do they reach Marissa and Andre? How do they reach you?
You can reach me by cell. Cell phone number is 773-290-9929. Or you can reach me by email, Marissa Hazelwood at epic.mortgage. I got so many emails. I'm
Nah,
sorry.
you good. I'm the
Caught
same
me
way.
off guard, that one.
Same way. Yeah, for me, cell phone number is 708-378-6242. Email address is acottrell at epic.mortgage. And yeah, feel free. You don't always have to just call. You can also text us. You can text me, email me. I don't mind responding to, just some words. So that's me.
No, that's awesome. All right, we'll go to the next one. We got Jennifer Carter. That is a common name because I have a client, Jennifer Carter, and doesn't look like that. But hey, Jennifer, what are red flags to avoid when choosing a lender? Oh, great question. What do you guys think? How do we
Marissa,
choose
you
the
go
right lender?
first.
I would say communication, right? You want a lender that's going to communicate with you at all time, working weekends, day and night. At least that's me here. Communication is the key. Someone that's thorough can explain the programs, why or why not you should go with one program over the other. Then will be my two main. Go ahead, hit them, Dre. I'll think of some more.
I just have one to kind of leech on to what you just said. If you get off the phone with your lender and you're still confused, go somewhere else. If you just don't understand, if you get off and you just felt like you heard someone do trigonometry, get off just find someone else and keep looking for someone who can explain things to you, because this is going to be one of the biggest purchases of your life, and you're going to want to know the ins and out of everything that's going on in your loan. And loan disclosures and the Information Act that's out right now is very good for the consumer. You're going to get all the information on your loan, but some people still want things broken down even when it's in layman's terms. So I would say if you're not getting thorough enough explanations, find someone else.
Yeah, I mean, real estate and relationships go hand in hand, right? I mean, we're trying to build relationships, and so you want to feel comfortable with who you're talking to. You don't want to feel like you're intruding on somebody when you call them and ask questions. You don't want to feel intimidated, like, oh, he's going to get mad at me if I keep asking questions. That's not a healthy relationship. And so, what we want to do is build a relationship with you, and hey, we could be friends. We can be associates. I don't have to go to Bobby's graduation party. I may not be invited, to the anniversary party, but when you have a financial question, you know who to call.
Yep.
You know who to call. And that's all I'm trying to be. I have a family, so I get it. It's okay. It's not going to hurt my feelings. But when you have a financial problem, give us a call and we can help you out. And I think that's important to note, that you're building relationships that can hopefully be long term. There's sometimes I get clients and they're like, oh well, I went with somebody and then I went back there and that person's gone now. And that's what I want to let them know, hey, I'm going to be doing this the next 20, 30 years. I'm going to be doing it. I'm right here. I'm here for you. And, as long as I'm still working, I'm here for you. So you feel free to give me a call, and we take it from there. So I think, any red flags, if you don't feel the vibe, right? Now, you youngsters, you guys got that vibe, that's that new word. So, that's that millennial thing. So, if you're not feeling a good vibe by the person, I think you should exit stage left for sure.
I agree.
All right, next question. Hey, once again, keep them coming. I appreciate all these questions. We're here for you guys once again. So we're live on Facebook, LinkedIn. So tell a friend, a neighbor, a coworker. If someone's now just going to lunch right now, if they could take a 15-minute break, I know they take those 15-minute breaks and go on Facebook and LinkedIn or whatever. Just tell them to jump on, ask the questions. So I appreciate it. Keep them coming. All right, next question we got here is David. How can investors leverage tax strategy to scale faster? Interesting.
That's a good question.
Yeah, I'll tackle this one if you guys are okay with that. What I would say is real estate investors nowadays, what we really have seen is just a transfer to alternative income. And what has been really popular as far as real estate investing has been what is called DSCR. And that's a debt service coverage ratio. And these are cash flowing loans. And what I mean by that is what we do is we focus on the cash flow of the property and not necessarily the income of you as an individual. So it actually eliminates the tax strategy to scale faster. So if you have, the credit, so like I said earlier today, I said, hey, for primary buyers, primarily, you're going to need to be able to prove credit, income, and assets. Those are the three, that's the little CIA. But in the investment world, we really focus on two, which is credit and assets. So if you have, $250,000, $250,000, and you want to get into real estate investing, then we can go as high as potentially 15% down, and in some cases even as high as 10%, with a seller second financing. So we have a huge opportunity right here to limit how much down payment you need, and then from there, just try to maximize it. And it's based on the cash flow. So what I mean by cash flow is if we have a property, let's call it a duplex, right? I'm thinking more regional base. In Chicagoland area, we call them two flats, but in your neck of the woods, you might call it a duplex, a 2-unit property. If that property is producing, let's say you're getting $1,500 per unit, that's $3,000. As long as your mortgage payment is $3,000 or less, that would allow you to buy that property, no ifs, ands, or buts. And we're not providing any documentation from you. I'm not looking at tax returns. I'm not looking at W-2s. I'm simply saying, hey, you have the money in the bank. We can go ahead and move forward. So that's a great opportunity right there for you to scale faster and not being, tied down with some of the restrictions on, debt to income ratio and, my taxes, I need to refile or I need to amend them. We kind of eliminate that with that product right there.
Yep.
What do you guys think about that?
Agreed. Yep.
Yeah. So, the investment world is something that, we really kind of focused on over the last 4 years. It's something that I think we're really strong at. We're doing renovation on the investment side, which, it's hard for you to find. So any type of fix and flips, definitely look out for us. We're definitely can help you. We have lenders that can do this. We close that on a regular month-to-month basis. These DSCR programs that we're talking about right here, there's some that we strive in, so we can get you in and out and close within 30 days. These are not long drawn out processes. So, these are huge opportunities that, definitely, if you are looking to scale, definitely give us a call. All right. Well, then let's go to the next one. Let's see.
These questions are really coming in. All right, okay, we got another one.
This one for you, Dre. This one for you.
All right, what advice do you have for buyers in today's high rate environment?
Oh, good question.
Man, I'm gonna always be based on like real life examples and just like how I process my thoughts. So rates suck. Everybody know that. Everybody around the world know that rates suck. It is apparent. Everyone knows that, 5 years ago, rates were low. And compared to now, they're horrible, okay? And no one knows that more than me, all right? When I got into the mortgage game almost 5 years ago, that's why I got in, because rates were so low. And I was watching mortgage loan officers at the company I was working with prior make money hand over fist. Everybody was buying new cars, buying new Jeeps. Everybody's going to Vegas. And as the years have gone on and that I've been with Dante, I've literally watched rates go from 2 to 3 to 4 to 5 to 6 to 7. Okay. So I'm feeling it a little harder than, some other loan officers may have felt it in their careers. So I just say, in today's high rate environment, it's based on risk, okay? And everybody is a little bit more risk specific than some. Some people are gonna go to this casino and they're gonna bet $100 and they're gonna be done. And some people go to the casino with $10,000. Some people are just more risk adverse. And I'll use the example of one of the first loans that I ever did. It was somebody who got a really low rate. And, it's one of my good friends. And he called me today and he's also got that good rate. And he said he was up like $50,000 in equity. His home has also appreciated more, so he took some risk in, and he didn't have a lot of risk in that environment with getting a low rate years ago. But that's kind of what I'm thinking about now when I strategize with clients. It's like, what are you doing to actually combat this rate? Like, why are you moving? Like, how much does this rate mean to you to move? Like, this how much does this home mean to you? Because I have clients right now who don't really care about the rate because they just don't want to be where they're at. They're ready to get out of an apartment. They're ready to get out of a bad neighborhood. So that's what I kind of mean. Rate is kind of like risk to me. It's like what's going on in your life that is gonna, bring you to the point where you are gonna get a mortgage right now at a 7% interest rate, possibly. So it's to each their own. That's what I have to say.
Marissa?
What do I have to add to this? I mean, like everybody individual situations is different, right? And we adjust ourselves for the market all the time, right? Everything is high, not just rates, right? Food is high,
Yeah,
everything. So, I mean, we have to just adjust ourselves. Rates only high because we saw a lower rate, and then it's not the highest it's ever been. So,
exactly.
I mean, we just have to adjust ourselves to the market like we do with anything else. If you can afford it, it's in your budget. Go ahead, go for it. What they say, marry the house, date the rate, right? We can always refinance in the future. So I wouldn't be too much concerned of, oh, rates are high. I'm more concerned of, can I afford this? Can I get it done?
That's awesome. To your point, 2002, June 24th, 2002 was my first day in the mortgage business, and interest rates were 10.25%.
Mm-hmm.
And so to your story, Dre, going from 10% and watching them go all the way down to like 1.75, literally got a client 1.75% on a
Wow.
15-year, and now watching them go on the uprise. It's been polarizing, to say the least. But if you look at the last 50 years, and I know that's hard for some, but 1975 to 2025, the average interest rate has been 8% on a 50-year look. The issue has obviously been a situation, to your point, 2010 to 2020, the average interest rate was 4%. And so, the market was discounted. It was like shopping at Kohl's, right? Everything was on, coupons, and everything was on sale. And then all of a sudden, here we go with this rate increase. So I guess what I'm saying overall is that historically, these are still low interest rates.
Mhm.
So sometimes when people say high rate environment, I always want to give them that spectrum so they have a better understanding, because this is kind of normal rates and it's still historically low.
It's a
If we
small
were,
bubble. It's a
yeah,
bubble.
Yeah.
the issue is, and this would be the pushback for most. If they heard that, they'd be like, well, yeah, Dante, but back in 1975, the average home was 50,000, 75,000. So we see the appreciation that has gone up. That's what's changed the dynamics. It's the cost. It's the payments per month has changed from the 75,000, 10%, that's $750 a month, to now, 7% of 300, 400,000. That's the change that we've seen. And to some degree, based on, just population sizes, right? So when we look at generations, the number one generation we talk about is millennials. Millennials from 27 to 43 are the biggest population of people that we have. The second biggest is Gen Z, and they're like 19 to 26.
Mhm.
And so if you look at a 19 to 43 are the two largest populations. Well, guess what? Guess what they're going to be doing in the next 5 to 10 years? Getting married, having kids, and getting houses.
Mhm.
So, the story is, I don't see, unless, God forbid, another pandemic, and no one wants that.
No.
I don't see really a storyline that says housing is going to go down, because the people right now need homes. The demand is still going to be strong each and every year. And the only thing the pandemic did was it slowed down building. And so that's where we do need more infrastructure, more building, more people in the trades, building up more housing. And people are going to have to be willing to relocate to maybe areas they never thought of. Might have to relocate to Nebraska. Might have to relocate to Oklahoma. You might have to go to places that you never envisioned just to get a piece of land, because it's that competitive right now. It's that competitive. So I don't, and that's where it's kind of quirky right now. I don't really see a reason for rates to go down. They might be manually forced down for a period of time, but I think, rates overall are here to stay. And if you see the ship going this way, if homes were, 75,000 and 75, and now they're, I think the average median home is like 412 in the nation. Well, guess what? If they keep going up, you want to get a piece of that pie. We're taught we have to buy assets.
Mm-hmm.
So you got to get in where you fit in, and then once you can get in, you want to take advantage, because that's going to get you instant wealth, right? I mean, they say 85% of all millionaires have real estate. So, if you're ever thinking about your future, you're ever thinking about retirement, you got to get a piece of real estate because it's going to go up, and then you can sell the house, refinance, I've told the story, but, Epic Mortgage wouldn't be here today if I didn't own a house.
Yep.
Because that was equity I was able to take out to make this happen. So, owning a home, owning assets are super important. We're here to help, and that's the thing. But yeah, don't get intimidated of the high rate environment, because we're going to be here.
Let me cut in, Dante. That's literally what I was going to say. I was going to say there's a lot of fear mongering going on, and it's in anything. And at the end of the day, buying a home is still a good thing to do, because the realness of it is they're not building many homes. They're building more and more condos and more apartments, because that's what they wanted to put people to. They don't want people having home ownership, and they're trying to take that away from us as Americans. So I say buying a house is still one of the most American things you can do, and one of the most financially beneficial things that you can do, because the people who own a property, they want multi-units. They don't want to put one house on 1 square foot of land when they can fit 5 apartment buildings there, because that's going to make them more income than that one house. So
Correct.
That's where the fear mongering is coming from, because the people who are investing, they are investing into townhomes and more multi-family living. I don't know what that's called, condos, apartments. Those are the things that they're building more than single family homes. You don't see too many of those development projects going on like you did 10, 20 years ago when they were building up whole subdivisions. They're not doing that anymore for a reason. So yeah, while they're fear mongering you, so you got to look at the signs, and you got to be able to tell that something's off with that, and that's what it is. They're gonna make more money building more apartment buildings than they are single family homes.
And they call them affordable homes. It was Shady McCoy, the former running back for the Eagles. He renamed this thing, to your point, and it's really just an apartment complex. And it's like, oh, these are affordable homes, and it's like, but that's renting. You're promoting renting.
Yep.
You need to be an owner so you can get a piece of this pie. You're going to be left out if you're not owning. You have to find a way to own property. It's just paramount that we all do that. So, very key on this whole thing. But we are getting close to that hour. So let me finish up here. I think we got a couple nice things: clear, engaging, packed with value, amazing content. Thanks, you, Dixon. Kathy wrote, loving this episode. Keep it going. Appreciate you, Kathy. We'll be back on Thursday. We got Vince Bertuccini and Yolanda Peavy is going to be with us on Thursday from 12 to 1. So make sure you check that out. And then we'll take it from there. We got Jason Tilley, great video, powerhouse guest today. Yeah, Marissa and Andre, man, they did their thing. So I appreciate you. I appreciate them for jumping on. And then let's see here. We got Danny, real-time value. Love this format. Hey, appreciate that. Thank you.
Thanks, Danny.
Yeah, this is what we're trying to do. Epic Mortgage, we're trying to get out to the community. We found this is going to be a way, through the digital airwaves. We're going to be here, try to get out here Monday through Thursday from 12 to 1, spread some knowledge, answer your questions that you have. We really appreciate you guys participating. I had an outline. Once again, didn't even use it.
We got through it a little bit.
Man,
we got through one question.
We got one question.
That was good, though. They came with the question. So, I mean, we got to engage the audience.
Yeah.
We'd rather have that than
some of them were kind of answered throughout the audience questions. So
okay. I was like, man, we got one question in. But no, I appreciate you guys joining us. Once again, let's give out all the contact information. Go ahead, Marissa, kick it off.
All right, I'm Marissa Hazelwood. loan officer with Epic Mortgage, also tax accountant. You can reach me at 773-290-9929. Email is mhazelwood@epic.mortgage.
Awesome. Dre.
Yes. Cell phone number is 708-378-6242. Email address is going to be Cottrell at epic.mortgage. And you can also follow me on Instagram. I don't know why I didn't say that earlier, but
Hey,
yeah, Instagram Mortgages by Dre. So like Beats by Dre, you just put in mortgages. So Mortgages by Dre. Hit me up on there. Send me a DM, whatever you got to do. But yeah, reach out if you have any more questions.
Awesome sauce. Obviously, corporate office 708-905-5300, 708-905-5300. Appreciate everyone. Man, we had 241 people listeners. Appreciate that. That's awesome. We're going to try to get that number up and going. So please tell everyone about it. We'll be back on Thursday with Vincent Bertuccini and Yolanda Peavy. And we're going to continue to spread this knowledge, answer your questions so you can use this and hopefully, take advantage of the market. It's great opportunities. And shout out to the Jones family that should be closing in about 2 hours. So appreciate everyone.
Congratulations.
Yeah. So that's super cool. So appreciate you guys. Hey, we're going to have to get you back on now.
Yeah, we have to come back on. Just let me know, Dante, whenever. Just give me a little bit of time like you did. Yeah.
We'll see.
Man. Don't hit me up day of.
I know. This is gonna be pre-planned. I'm gonna ask in advance, so we got spots for next week. So let me know when you guys have time. Love to have you guys back on.
Cool. All right, y'all. Bye,
Marissa.
Take care. Good talking to you. Good seeing you.
Good one.
All right. Have a good day.